At the end of a fiscal year, a company signs a 3-year AI infrastructure commitment to secure a lower unit price. The operating plan assumes usage will expand into the reserved capacity. The contract is approved, the platform team is funded, and the expected margin improvement is built into the budget. 12 months later, demand is growing, but not at the rate the cost structure requires. Each interaction is cheaper to produce, yet the company is paying for capacity it does not fully use. No competitor forced a concession. No major customer reopened a contract. The margin weakens because the operating system was built for a volume that did not arrive. A business can lower the cost of activity while raising the cost of being ready for activity. That distinction is difficult to see during adoption. Early workloads are concentrated, teams operate with unusual discipline, and temporary resources absorb transition pressure. The economics are measured when attention and utilization are near their highest. Mature economics begin when those conditions disappear. Long-term margin sustainability is not the spread achieved during launch. It is the recurring spread that remains when demand varies, capacity is partly unused, quality obligations become permanent, and the operating model must support ordinary rather than selected workloads. Consider a modeled business with $120 of revenue and $84 of gross cost. Gross profit begins at 36. Automation removes $9 of direct delivery cost. The company then carries $4 of committed platform capacity, $2 of recurring quality assurance, and $2 of transition overhead. Gross profit reaches 37 rather than 45. The calculation exposes the boundary. Lower production cost creates durable margin only when the surrounding commitments remain economic after utilization returns to normal. Some expenses fall with activity. Others remain once capacity has been installed. Model hosting commitments, data pipelines, security controls, integration layers, and specialist teams can behave as structural overhead even when volume softens. The cost curve may flatten at high utilization and steepen again when demand becomes uneven. Peak utilization spreads fixed cost efficiently. Normal utilization reveals how much capacity was built ahead of demand. Sustainable margin requires the system to remain economic at the utilization level the business can repeatedly achieve, not the level reached during launch. Aggregate gross margin can remain stable while the composition beneath it deteriorates. High-margin customers may use little, while lower-margin customers consume more inference, customization, or specialist attention. A blended figure can conceal which cohorts are strengthening and which are becoming structurally expensive. The reported average can hide a weakening economic center. Finance, therefore, needs to follow cohorts over time. Newer customers should become cheaper to serve as they mature. Older customers should retain their economics. Expansion should increase contribution, not merely activity. Under quarterly budget pressure, a company may approve new AI capacity because the current margin can absorb it, then treat that capacity as committed before demand proves persistent. The immediate P&L remains acceptable. The future cost base becomes less reversible. Margin durability depends partly on how easily the system can contract. That does not mean avoiding fixed investment. The issue is whether commitments are tied to proven recurring demand, whether contracts can be resized, whether duplicated processes have clear exit dates, and whether new capacity replaces old capacity rather than sitting beside it. Reversibility is an economic asset. A system that can expand quickly but cannot reduce capacity, tooling, or specialist labor without disruption carries a higher margin floor than its unit economics suggest. The cost of readiness remains even when demand pauses. A sustainable system must absorb exceptions, quality failures, demand spikes, and temporary underutilization without producing a disproportionate cost response. If a small increase in complexity requires a large increase in specialist labor or infrastructure, the margin is stable only inside a narrow operating range. The governing condition is now visible. Long-term margin sustainability requires a recurring cost floor that remains below realized revenue across ordinary changes in utilization, product mix, quality burden, and reinvestment. The objective is not to eliminate volatility, it is to prevent normal volatility from forcing a structural reset. The practical measurement is longitudinal. Finance should separate temporary effects from recurring cost, track fixed and variable components independently, compare cohort contribution over time, and test the economics at several utilization levels rather than one forecast average. It should also identify which expenses can contract and what operational damage contraction would cause. The strongest evidence is not one exceptional quarter. It is repeated stability after assumptions move. Apply that standard to the earlier calculation. The $9 production saving was visible. The durable improvement was the $1 left after permanent platform, quality, and transition costs were recognized. That figure is smaller but more informative. It reflects the structure the company must carry forward. Long-term margin sustainability depends less on how much efficiency appears at adoption than on what remains after the system becomes ordinary. A resilient margin can survive mature utilization, changing product mix, recurring quality requirements, and disciplined reinvestment without relying on temporary restraint or concentrated workloads. AI can widen the margin once. The economic test is whether the operating structure can keep it wide without becoming rigid, overbuilt, or dependent on exceptional conditions. A sustainable margin is not the highest spread the business can report. It is the spread the business can repeatedly preserve through normal operation. The underlying economics are durable only when the margin floor, not the margin peak, improves.